That is the effective monthly net income of a full-time minimum wage worker in Portugal in 2026. Not the headline number, the usable number. Portugal's legal minimum wage is €920 gross per month, paid 14 times a year. Spread across 12 months, that becomes €1,073 gross. After the mandatory 11% social security contribution, it leaves roughly €955 net per month. That is what a small one-bedroom apartment in Lisbon can easily cost on the open rental market today, €1,250 or more. Not a luxury penthouse, not a foreigner-only villa, a small T1 apartment in the capital. Before food, before electricity, before water, before transport, before saving a single euro, the worker is already almost €300 short every month. And this is the generous calculation. Because if you look only at the regular monthly paycheck, before spreading the 13th and 14th salaries across the year, the monthly net pay is closer to €819. Now here's the part that makes this more than a housing story. On paper, Portugal just had one of its strongest decades in a generation. Debt down, tourism booming, rating agencies upgrading, Brussels applauding, the IMF, the same IMF that imposed austerity on Portugal in 2011, now holds it up as a model, and the math above is still real. So the question is not whether Portugal recovered. It did. The question is, who did the recovery recover? To understand why, go back to 2011. Portugal is running out of money. The Eurozone debt crisis has hit. Bond yields spike above 10%. The government calls the IMF. The Troika arrives. The European Commission, the ECB, and the IMF. And the price of the bailout is austerity, spending cuts, privatizations, reforms, and a constant, urgent need to prove to global markets that Portugal is safe again. Portugal needed capital, credibility, and growth. Fast. So it did something rational. It made itself attractive. In 2012, the Golden Visa launched. Buy property for at least €500,000, get an EU residency permit, and spend as little as 7 days a year in the country. Already running since 2009 was the non-habitual resident regime. The NHR moved to Portugal, qualify, and pay a flat 20% income tax rate on Portuguese earnings. Foreign pension income was taxed at 10% for 10 years. The pitch to the world was simple. Bring your money, pay less tax, live in the sun, access Europe. And it worked. Capital came in. Historic neighborhoods got renovated, tourism surged, Portugal became globally visible to a class of people who had never given it a second thought. House prices in Portugal rose by 141% between 2010 and 2025, the steepest rise of any EU member state over that period. In the second quarter of 2025, prices were up 17.2% year on year, the fastest increase in the entire EU. Now look at that number again, 141% in 15 years. Wages did not go up 141%. That gap between what housing costs and what Portuguese workers earn is the entire story. But the tragedy is that none of this was irrational. In 2012, Portugal needed money, credibility, and growth. The model solved the crisis it was designed to solve. It just created a new one it was never designed to prevent. But wait, shouldn't foreign investment raise wages too? More capital, more jobs, more money flowing through the economy. That is how it is supposed to work. Here is exactly why it did not. The problem with using real estate as economic policy is that once homes become investment assets, financial products, tax strategies, short-term rental income, local wages stop being the reference point for prices. A German retiree with a pension of €3,000 a month does not care that Lisbon's average salary is roughly €1,550. Lisbon still looks cheap to them, so they can pay. A US remote worker earning $7,000 a month can afford €2,000 rent and still feel like they are saving money. The market sets prices for people arriving from the outside. It does not ask whether those prices work for people already on the inside. In Greater Lisbon, in 2025, buyers with tax residence abroad paid 61.9% more than domestic buyers for equivalent property. In Porto, the foreign buyer premium was 35.6%. Then Airbnb made the structural problem worse. A landlord in central Lisbon can earn €3,000 a month from tourists on a short-term let, or €1,200 from a long-term tenant. The market has told them exactly what to do. Long-term rental supply shrank exactly where demand was highest. Families moved to the periphery, students shared rooms, teachers, nurses, and police, the people cities actually run on, started commuting 90 minutes each way. In July 2025, the average rent in Lisbon was €19.6 per square meter. That means a 60 square meter flat costs roughly €1,176 per month. The national national average was 16.7 euros per square meter. And this is where the opening numbers matter. The 1,250 euros figure is not the average rent paid by every tenant in Lisbon. Older contracts can be much cheaper. But for someone entering the market today, a young worker, a nurse, a teacher, a new arrival, the asking rent is the reality that matters. A small T1 apartment in Lisbon can easily cost more than the effective net income of a full-time minimum wage worker. This is what economists call a dual market. Two economies, one global, one local, sharing one housing stock. And the global one wins every time there are not enough homes to go around. Portugal did not just attract wealth, it attracted an external pricing mechanism and plugged it directly into a low-wage economy. External prices, local wages, one housing market. Now Portugal did respond. In 2023, it shut the Golden Visa's real estate route. In 2024, it closed the original NHR regime to most new applicants. Politicians said the crisis was over, except by 2025, prices were rising faster than anywhere else in the EU. Here is why the obvious fix did not work. In October 2023, the Golden Visa real estate route was closed. By the end of 2023, the original NHR regime was closed to most new applicants. On paper, the two main foreign buyer incentives were gone. And yet by 2025, house prices were rising 17.2% year on year, the fastest rate in the EU, by nearly 2 percentage points. In the fourth quarter of 2025, the median price in Lisbon reached 5,198 euros per square meter. A 55 square meter apartment at that price costs roughly 286,000 euros. A minimum wage worker's annual gross salary is 12,880 euros. Without interest, without food, without taxes, without life, that is more than 22 years of salary. So if removing the foreign buyer incentives did not stop prices, what is actually driving them? Three things. 1. Supply was never built. During the years when foreign capital was flooding in and renovation was booming, Portugal did not build enough new housing stock. After 2020, construction slowed further because of labor shortages, material costs, and licensing delays. The OECD's 2026 Portugal review identifies supply as the binding constraint. You can close every visa program in Europe. If there are not enough homes, prices rise. 2. Domestic demand filled the gap. Between 2020 and 2025, average Portuguese wages rose around 30%. Mortgage conditions improved. More local workers could access credit. They are competing for the same undersupplied stock that foreign buyers used to compete for. The market does not care who is bidding. 3. Foreign demand did not disappear. It adapted. The Golden Visa still runs through fund investment. In 2024, the program recorded 4,987 approvals or residence permits, up 72% year on year. Closing real estate did not close the program. It redirected it. This is the trap Portugal built for itself. Attractiveness has momentum. You can close a visa, you cannot close the weather, you cannot close the coast, you cannot close the language, you cannot close the Schengen area, and you cannot close the fact that Lisbon is still cheaper than London, Paris, Amsterdam, or Munich. Even at these prices. The crisis was never only about who got a specific visa, it was about what the country became structurally dependent on and what it never built alongside it. Which brings us to the part of this story nobody wants to say out loud. When housing gets unaffordable, someone gets blamed. In Portugal right now, it is not usually the investors. It is not usually the retirees. You probably already know where this is going. Portugal has about 10 million people. By 2025, roughly 1 in 10 residents was a foreign national. The foreign resident population has more than tripled in a decade. Most of them are not Golden Visa investors, remote workers, or foreign retirees. Brazil is Portugal's largest foreign community. Behind Brazil are large communities from India, Nepal, Bangladesh, and Pakistan, working in construction, agriculture, restaurants, delivery, cleaning, and elderly care. These are not the people who priced out Lisbon apartments. But when rents rise, wages stagnate, and neighborhoods change, politics collapses that distinction. Nationalist parties offer a simple story. Immigration caused this. Restriction is the cure. The language is extreme, but it is landing. Because the underlying frustration is real. People see their children leaving, they see rents rising, they see services strained. They connect those dots along the line of who arrived, not along the line of what was built and what was not. Youth unemployment in Portugal was around 20% in the third quarter of 2024. The average annual wage was about 23,177 euros, among the lowest in Western Europe. Young Portuguese are not primarily leaving because of immigrants. They are leaving because France and Germany pay far more for the same work. Portugal needs migrants to fill the jobs its own youth will not take at Portuguese wages: agriculture, construction, hospitality, care work, restaurants, delivery. These sectors would contract without them. So the country simultaneously needs immigration and has not built the housing, processing capacity, or integration infrastructure to accommodate the people already there. The political backlash is filling that policy gap with a simpler story. And simpler stories in tight housing markets tend to win elections. So what actually changes this? There are three paths. None of them are fast. 1. Build, not luxury units, not tourist apartments on the periphery. Affordable long-term rental housing, close to where people actually work. The OECD's 2026 Portugal review is explicit. Supply is the binding constraint. This is politically unsexy. Permits, land, construction labor, zoning. But it is the only thing that changes the price floor. Everything else is noise. 2. Raise wages through productivity. Portugal's economy still leans heavily on tourism and low-margin services. That structure keeps wages structurally low. The only mechanism that closes the gap between what housing costs and what workers earn is moving toward higher-value industries. The new IFICI plus regime, Portugal's replacement for the NHR, tries to do this by targeting scientists and tech workers instead of retirees. It is a better designed incentive than the original NHR, but it will take a generation to move average wages. 3. Manage immigration honestly. This is the hardest politically, because it requires admitting two contradictory things at once. Portugal needs workers, and it has not provided the housing, documentation speed, or integration infrastructure those workers require. Portugal's revised nationality rules extend the citizenship timeline from 5 to 10 years for most non-EU nationals. The clock starts from the date the residence permit is issued, not the date the application was filed. That detail matters. Portugal's immigration agency, AIMA, still leaves many applications waiting months or years, which means bureaucratic delay becomes a personal penalty for people who did everything right. Portugal sold a promise: come here, follow the rules, build a life. That promise is now being rewritten mid-sentence for people who already moved. That damages something harder to rebuild than housing: trust. Trust in the predictability of the system itself. And a country that can no longer be trusted to be predictable will stop attracting the people it actually wants: workers, families, talent, while still attracting the capital that prices them out. Here is where we land. Portugal's recovery was real. The debt came down. The economy stabilized. The country held together under a level of austerity that would have fractured others. But the model that saved Portugal also turned it into a product, a place to invest, a place to retire at a discount, a place to work remotely on a foreign salary, a place for tourists. And products get priced by whoever can pay the most. 955 euros effective net income, 1,250 euros or more for an open market Lisbon T1 rent. The minimum wage worker in Lisbon cannot pay the most. They never could. The recovery was not built around their purchasing power. This is not a story about foreigners destroying a country. It is a story about a country that survived a crisis by becoming attractive and then never asked what it would cost to stay livable for the people who were already there. Portugal can win back the confidence of global capital markets. What is less certain is whether it can win back the confidence of its own people.